Good morning to today's webinar, The Fixed Asset Alternative. My name is Brian Leising, and I will be your host for the next 20 minutes or so. If you're not familiar with financial brokerage, we are a national marketing organization working with independent producers and advisors all across the country in the areas of life insurance, annuities, long-term care, Medicare, supplements, critical illness, disability insurance coverage, and probably something else that I forgot. I've been with the company for over 15 years now, and many of you that I see that have logged in already know me and have worked with me. We've probably even met a few times here. But this morning, I wanted to go over something which is a relatively new concept. Some of the insurance companies that we represent here at Financial Brokerage are seeing a tremendous amount of business flowing into them on these products that are, they happen to be single premium life insurance products. And there is a certain market for it. It happens to be very, very lucrative. So you can make a lot of money by discussing this with the right clients. And at the end of the webinar, I'll tell you what kind of clients you want to look for this opportunity. But we're going to go over three things here this morning primarily. We're going to start by looking at the problem that some people face out there. What is the marketplace for this? What are the current or the traditional options that people have used for their fixed assets, and then we'll finally get into some different single pay life policies that may be a good fit for some of your clients out there. So if any of you have done any sort of retirement planning with your clients, you're probably doing some sort of an asset allocation with them. You want to be able to make some money, maybe have some money in the market for your clients, but also, we realize a portion of their money should not be exposed to that same level of risk. But when you don't expose it to risk, you also have the risk of not making much on that money. So that's what we want to look at today. Your clients' fixed assets, the money that is not in the market, they're not putting it at risk. And I think it's really interesting to see exactly how much money is out there. Now, I just did a Google search a couple months ago to try to get the numbers and nail that down. And everybody's got a different number, but I tell you what, it's a big number. Here's a headline from Business News back in August. BlackRock sees $70 trillion of cash in the sidelines that could boost stocks. In fact, if you go into the article, it tells us that there was $70 trillion, trillion with a T, on the sidelines. And this isn't in the market, so people are earning next to nothing, and I've got some examples that can show you what they're probably earning on that money right now. There's more cash in the system than ever before. Going on in their article, for a lot of folks, that money is effectively earning a negative yield. When you combine that low interest rate with the taxes they have to then pay on that and take into account inflation, you know what, they're probably losing money on the money that is on the sidelines. And obviously, most people are very unhappy about that. Another headline here, now this came from CNBC, this tells us that billionaires are holding $1.7 trillion in cash. Now this talks about the world's billionaires, so this does not just apply to the United States, but to folks all around the world. So it's not unique to us here in the U.S. This is the highest amount on the sidelines since I began recording this number back in 2010. And in fact, looking at the world's billionaires, 22% of their total net worth is now in cash. That's very liquid, and that's money that we can tap into to try to help them actually make something on that. In fact, that total amount of cash is roughly the size of Brazil's GDP. So there is a tremendous, tremendous opportunity out here. Billionaires taking money off the table, and that's primarily due to uncertainties in the economy, both here and around the world. We've certainly seen some uncertainties in the market last night and today. So, not knowing what's going to happen, not wanting to risk a loss, people are just taking that money off the table, and it's not doing a whole lot for them. Here's a statistic. I don't know where we got this from, but one of our carrier reps that comes in here to our office every now and then mentioned that historically in the United States, people with more than $1 million in assets will keep 25% of their money liquid. Now that number fits very well with the article there that said what billionaires have got about 22% of their total net worth in cash. So there's a lot of money out there is what all this points to basically. We want to take a look at where those dollars are now and if there might be an alternative solution for at least some of that money. So where might that safe money be right now, the money people can't afford to lose? Well, they're probably going to put it in a bank. They might put it into a fixed annuity. They might put it into a bond. Now, what are all those vehicles paying? Well, I did a Google search. Anybody can do this. This was a month or two ago. I tried to search for the highest payout for a bank CD that I could find. And I really didn't care how long we were going to lock the money up. So best I could find was a 5-year CD paying 2% and several others paying less than 2%. Okay, that's not a whole lot right there. And your money's locked up for 5 years. Well, what if we don't want to lock up the money that long? What's the best rate I can find on a 1-year CD with banks? Well, 1.25%, 1.3%, just over 1% if we want a little easier access to our money. But what if we want even easier access than a CD? Let's look at a savings account or a money market account in this case, and maybe we're going to be up there near that 1-year CD at 1.26, but more likely we're going to be just barely over 1% if we want immediate access to our money in the banks. Okay, so what if we're not putting our money in the bank, we're doing a little better, and we're going to put it in an annuity because we don't like having to pay taxes on that money every year. We want to at least defer the taxes to another day. Well, as of last month, I checked with my counterparts here because we work with annuities at Financial Brokerage. I asked, what is the best interest rate a client can get on a fixed annuity, a fixed interest rate? And highest number we could find at that time was 3.35%. So we're doing a little bit better than the banks, but that also assumes that we are locking up the money for 10 years. Your clients aren't going to be able to touch that for that period of time. I thought, well, what if somebody doesn't want a fixed rate of return? What if they like the concept of an index product? What's the highest point-to-point cap on an index annuity out there right now? And best we could find was 5.6%. Now that was a month ago. That may have changed, and I really don't remember which company that was with. I was just trying to find the highest rate. So, maybe a person puts it into an index annuity, and best we're going to do is 5.6%. We can likely do better than that with one of these single pay life products I'm going to show you in a minute. Now, I also started to wonder, what about bonds? Bonds are usually seen as safe money vehicles that clients might put money in. Well, and I don't know, I didn't neglected to put what they're paying right now, but what will happen to a bond fund when interest rates go up? I mean, we've been in a historically low interest rate environment for a long, long time. You would think they're bound to go up before too long. Well, unfortunately, the bond funds are going to decrease in value because people can make more money elsewhere. So people don't necessarily want to lock up their money in a bond when they think interest rates might be going up sometime in the near future. Now, if they put money into the fixed asset alternative, the single premium life insurance product, guess what? When interest rates go up, interest rates will likely go up in that life insurance product as well. They're based on current interest rates. So what you should be asking yourself is, right now, what are your clients doing with their fixed assets given such low interest rates? When do they think the rates are going to go up again? I mean, I don't know. Do you know? Clients don't know either. And when they do go up, do you think your clients are going to have the flexibility to move to some higher interest vehicles when that happens? So here's what the alternative asset is going to do. It's going to be able to give your clients a higher rate of return with even more liquidity than their current fixed asset products. That's assuming that they have their money in one of those things that we just described right now. And probably the best way to show this to you is by using some examples with the 3 products that are available. So before I get into specific companies and all that, what we're looking at here is a single premium life insurance contract. Depending on the insurance company, it may be available with no paramed exam. The better performing ones are fully underwritten, but there are some scenarios where your client can get by with just a phone interview and a paper application. Keep in mind, these are all going to be modified endowment contracts, and it's not a spooky word. That just means that the tax treatment of the contract is going to be the same as an annuity. They're not going to be taxed as the money is growing. They will be taxed on the growth first once they pull the money out. So we have better taxation scenario than we do with the bank vehicle, which is taxed every year. We're in the same boat as the annuities. And one thing that really sets these products apart is that there are little to no surrender charges associated with the products. Some of them are designed that way. Others give you an option in how you design it, if you want surrender charges on there or not. It really kind of depends upon the client's needs and how much liquidity they need to have there. One thing we don't want to forget, since these are life insurance contracts, your clients can get a lot of leverage on their money. There is a death benefit. That's the primary reason people buy life insurance. You are purchasing that tax-free death benefit that will pass to your beneficiary. And you know, in many cases, give you an example, if you had 100 grand, it was sitting in the bank, person passes away, guess what? Their heirs get 100 grand, and then they have to pay taxes on it, so they actually get less than 100 grand. If you put 100 grand into a single pay life policy, the death benefit is probably 150 to 200,000. That's going to pass 100% tax-free to their heirs. It doesn't go through probate, so nobody has to know about it. It's not going to be printed in the paper. You know, ask yourself with your clients, how long would they have to keep their money in that bank CD or in that annuity for it to grow as much as this death benefit is going to give them on day one? A lot of times with the clients we're going to be speaking about, they don't have that kind of life expectancy, and especially at such low interest rates, they can't live long enough for the money to reach that level that that death benefit is going to be from day one. And how does this benefit you? Some of these products out there pay trail commissions. So if you're used to trail commissions, you're managing money already, the commission options are going to look very familiar to you. You're going to be paid a percentage of that total asset there every year as long as your client holds that contract. So there's incentive for you to meet with them regularly and keep that money there perhaps. All right, so let's look into the products a little more specifically. Now, we have three companies that do a great job with this particular concept. MetLife, they have a fixed interest UL. I'm going to talk about North American, their Rapid Builder Index Life product. And a third company is National Western. That would be the one if you want to get by without an exam for your client. So how does this work in real life? Well, I used a male age 57 for all of these examples, so they're all going to look the same as far as the money going in and the same client. I chose a male age 57 because one of the companies told us that is the average age of the client putting money into one of these types of products. They said average age turns out to be 57 years old. Depending on the company, one of these companies said they see an average premium going into these products in the $200,000 to $300,000 range. Another company told us their average premium going in as a single premium is $1 million. I chose $100,000 just for easy math. It's a 1 and a lot of zeros. That's easy for comparison's sake. So, all right, male 57, 100K going in. If we're looking at the MetLife fixed UL, that's going to give us a $225,000 death benefit right away. And this is a current interest UL. They're paying 4.45% interest right now. If you contrast that back with the best fixed annuity out there, look, 3.35 right there, and you've got it locked up for 10 years. If your client likes a fixed interest rate, we're going to beat the best annuity out there. Now, how does that look in action? Well, in year one, we do have surrender charges, cost of insurance coming out of this contract. And so at the end of year one, we're not going to have our 100 grand in there. In fact, we're actually going to have If we look at the internal rate of return, when all that's taken into account, we're going to have a negative percentage in year one. So if your client wants your money in 1 year, this is not the product for them. But let's take a look at year two. And this is, again, all current assumptions based on that 4.45% interest. Once we take everything into account, the charges coming out, year two, we've got a net gain of 1.61%. Now we're approaching that 5-year CD, right? And we're still better than the 1-year CD. Year three, 2.31%. Now after 3 years, we're beating the best bank CD out there, and we only had our money in there for 3 years, not 5 years. And again, it stays around in those upper twos. If your client keeps it in there for 10 years, I mean, now we're getting 3% overall internal rate of return, and just over 3 still there in year 15. So again, this competes very well with the bank CDs out there, and you know, a lot more liquidity for your clients than any fixed annuities that you're going to find. Now, I'm going to talk a little bit about underwriting with this product. This one is fully underwritten with a couple of exceptions. So fully underwritten means your client is going to have to go through a pyramid exam and do lab work, more than likely. MetLife does have a special program they call the Enhanced Rate Plus program. Any of your clients that are age 20 to 60, applying for $100,000 to $1 million of coverage, if they haven't smoked in the last 2 years, they have a chance to go through an electronic system with no pyramid exam, although we can't guarantee it's going to stay that way. So based on how they answer the questions, they might have to go through an exam, but there's a chance that they won't. So you might get a pass on that, you might not. All right, example number 2. Let's say your client, you know, thinks they could do a little better than just a fixed rate of return, even though 4.45 is pretty good. Well, let's take a look at North American's Rapid Builder IUL. We've got the same person putting in $100K, but in this case with this product, I was actually able to dial down the death benefit clear down to just $1 above that initial premium going in. And I used their default settings with the annual point-to-point index option. They currently have an 11.5% cap. Contrast that back with our best index annuity. That was 5.6, so we've got a cap that is about double the best index annuity out there. Now with IULs these days, they have to illustrate rates that project or are based on every 365-day trading scenario going clear back to 1950. When you do that, you get a rate of return, hypothetical historical, of 6.69%, and that's what I used. I also put on their waiver of surrender charges rider. So now the only thing coming out of here is going to be the cost of insurance. There are no surrender charges applied. You can run this with surrender charges on there too if you like. That's a way that you can increase your commission on this if you need to. But here's what happens based on our 6.69% historical, the 11.5% cap. Client puts in 100 grand. In year one, we've got 105,000. Our internal rate of return, once everything is taken into account, the cost of insurance, we're still making over 5%. In fact, if you look all the way through year 15, we're making over 5% on that internal rate of return the entire way. Contrast this with your best index annuity out there, and you're going to have to hit that cap every single year. And even at that, you might not hit these numbers here. So that's looking pretty good. Now, what if your client says, you know, I don't understand an index? You know, maybe you put them in this product for that waiver of surrender charge rider, but you don't want to deal with the index right now. Well, they do have a fixed rate of return option. It's not as high as MetLife's, but they are paying 3.75% right now if you want to put your client's money into that bucket, or you could split it. So what happens at 3.75%? All right, now we're back to competing with the bank CDs. We're getting over 2% on that internal rate of return every single year. That's based on their fixed account at 3.75. So still not too bad. Here's another what if. Life insurance illustrations, we have to show the worst case scenario, you know, the guaranteed column with the maximum cost of insurance charges and the guaranteed minimum interest rate. This column is guaranteed not to happen. Why is that? Well, because the insurance company is not charging the guaranteed maximum cost of insurance charges from day one, which is what would have to happen for that column to hold true. So we know the numbers will be better than this. We just don't know how much better. But anyway, this is a worst case doomsday type of scenario. On this product, they're going to guarantee your client 3%. That's not too bad. You know, good luck going to a bank and asking for them to guarantee you 3%, or even an annuity. Can you guarantee me 3% for the life of this contract? They're going to laugh at you. So here's what happens in this Rapid Builder IUL. Absolute worst case scenario. Look at this. End of year one, we've got a gain. Year two, we've got a gain. We always have a gain in this. And if we look at the internal rate of return, taking into account the cost of insurance charges, our rate of return is over 1.5% in almost every year. In fact, we're approaching 2%. This is your floor. This is the worst that this contract could possibly do, and it's not going to be that bad because we're not starting out at that level right now, right? So if you show these numbers, and in the illustration, you can actually show them 3 columns, all 3 of these here. The absolute worst case scenario at 3%, the fixed interest option, and then in the right column, historically, what would have happened based on that 11.5% annual point-to-point cap. So you can show them all side by side, and just ask your clients what they think. Can they beat those rates somewhere else? And chances are they can't. All right, so there's one other option I want to show you here, and this would be for your clients that they have smaller amounts of money, because most of these, like certainly the MetLife product and the North American, look, if we're not looking at least 100 grand, it's not going to look too good. So that gives you some idea what sort of clients you want to look at. If they have less money than that, maybe we look at this National Western product. Now, this is the one that does not require an exam. They take a short paper application, they conduct a phone interview, and your client's going to get a non-smoker or a smoker rate. It's pretty much accept or reject underwriting, and they have pretty broad criteria. So they'll take quite a few folks. But because of that, you're not going to see the same sort of returns. I neglected to put their cap on their annual point-to-point, but the weighted average index interest is going to work out to being just over 5%. All right, so here's our numbers. With this product, they have a waiver of surrender option, or a return of premium feature might be what they call it. So your client is always guaranteed to get their money back out of there no matter what. And so they're always guaranteed their 100 grand. It does take a little while, even on that current side, for their surrender value to show a gain. So that's going to happen somewhere there between years 5 and 10. The big thing on this contract, though, would be the lack of underwriting, or the lack of an exam, I should say. They're still going to underwrite. And certainly the leverage on that money. Now, when they pass away, that money passes tax-free. All right, so what do you need to do next? Well, to make this work, what you really want to do is make a list of your top 10 wealthiest clients. If they're not on that top 10 list, they're probably not people you want to talk to about this concept. So we're looking at your top 10 wealthiest clients and ask them a few questions. Ask them, right now, where are your liquid assets, the money that you can't afford to lose in the market? Where do you have that parked right now? And ask them, well, what are you earning on that money right now? Are you happy with that? What do you think of the rates of return, And then ask them, would you like to earn more than what you currently are on at least a part of those assets? We don't want to go after the whole thing. They're going to get defensive. Ask them if they'd like to earn more than what they are on maybe half or a quarter of that money, whatever number you want to toss out there, without giving up any liquidity. Right? They like the easy access to that money so they can move it somewhere else. And guess what? With all these examples, we have got a lot of liquidity, same liquidity, or in some cases better than what they're having right now with their banks. All right, so that is the conclusion of the webinar. I'm going to open it up for questions at this point. Before I do that, though, I would like to thank everybody for joining us this morning. And if you know some other producers out there who you think would benefit from hearing about the fixed asset alternative or benefit from working with us here at Financial Brokerage, by all means do not keep us a secret. We're never too busy to see who else we can help. And I tell you what, that referral bonus that we like to pay out to doesn't hurt one bit. So let me get to the questions here. I do want to thank everybody for your time if you have to go.